Today, my guest is Rama Krishna. Rama is with Zovest Properties. He's an IT professional, and he's recently acquired a multifamily property. We're going to talk about that and his path to it. But first, a quick reminder, if you like the show, we'd love to hear from you. You can like, share, and subscribe. And if you'd like also a comment, we'd love to hear from you. Also, if you'd like to see how handsome our guests are, please check out our YouTube channel. We're at Commercial Real Estate Pro Network. With that, I want to welcome my guest, Rama, to CREPN Radio. Rama, how are you?
Yeah, I'm fine, Darren. Thank you very much for inviting me. It's an honor and a privilege to be on your podcast.
Well, I appreciate that. And really, I'm looking forward to talking with you. You and I have known each other here for a little bit. We're connected in Jonathan Twombly's multifamily investment community. And I don't know, I know Jonathan was actually a guest on my podcast way back, episode number 36. Share anybody with that where he shared his story. But before we jump into your recent acquisition and kind of the travels that you took, if you could just share a little bit about your background.
Yeah, so I'm an IT professional. I came to this country 13 years back. I was in Belgium before 2002 and 2005. I was brought up in India. Had all my education till master's there, and came for pursuit of higher education and higher job prospects in other countries. I was in Europe and then came to US. I was in New York for 1 year. Came to Bay Area in 2005, and then I'm kind of stuck here for the past 13 years. I love the weather. I love the opportunities here.
No, it doesn't suck.
We pay more taxes and it's more expensive, but at least I cannot complain with other things what we have here. And then I was never into real estate at all. Even when my dad said, do not buy anything. Wherever you settle down, you buy your primary home. Do not buy any real estate. Nothing, zero. I came from that. I was living here. I was trying to save my money to buy my primary home. We were outbid with so many other bidders here. The San Francisco Bay Area, how expensive it is. So many multiple bids. Then I was thinking, around 2 years back, I was talking to my wife, hey, we're trying a lot to buy our primary home. So I have some money for the down payment, Darren. So I thought, okay, let me just try something. I told my wife, give me a couple of years. Let me invest this money out of state, not in Bay Area, to get some, returns. I started with single family homes. And, I bought 3 single family homes in Raleigh and Atlanta. Then I wanted to actually scale that this is not the way to scale, buy more and more single families.
Right.
Then I kind of let everybody kind of transition into multifamily. I kind of learned it from Neil Bawa here in Bay Area from Multifamily U. And I kind of learned it more syndicators and more educators, and started my path of multifamily in this year.
So literally just 2 years ago, you started your investing there, and that was, you said single families in Atlanta.
Yep, Atlanta and Raleigh. That's where I started. Just 1.5 years, 2 years back. That's it.
So, and then beginning of 18, you committed to multifamily. Is that right on the timeline?
Yes. At the end of last year, then I thought this is not the way to buy stuff, real estate for passive income. I was buying the single families. I'm making $250, $300 for each unit. This doesn't I cannot buy 50 or 60 single family homes to get my, and my target of passive income. Then I was researching a lot and I bumped into multifamily, went to boot camp with Neil Bawa back in February. And before that itself, I was kind of learning a lot and trying to offer properties because I had some experience in offering single families, started offering small multifamily. That's when I started actually doing it in 2018 from January, February this year.
Okay. So tell us briefly, because I want to go back
Mhm.
from success to your path.
Right.
You recently just closed on a multifamily property, correct?
Yes, a 59 unit Casa Grande in Jacksonville, Florida.
Okay, 59 units, so definitely more than the single family. And did you syndicate that?
Yeah, I syndicated this thing, but I had three more properties before doing Casa Grande, small multifamily, a 20 unit, a 12 unit, and a 30 unit. Three properties I bought. This is my fourth property, which is a syndication, 506B. The previous three were just partnership. They're small properties. And I'm under contract. I'm closing one more property next Friday, a 32 unit. So total five properties, all in Jacksonville, Florida, total 153 units this year.
Oh, it's outstanding. That's great. I mean, congratulations on your
Yeah,
success there.
yeah. Thanks, Darren.
Well, let's back up here because I
Yeah,
guess on the smaller ones,
yeah.
let's talk about how long you've had those
Right.
and a little bit about your path on those.
Yeah. So February, March, like I was offering a lot of properties in like in Atlanta, other places, like uh, we're not like I'm even Raleigh. I had like offered several properties. I was not getting anything. So I Jacksonville, Florida was not my market at all. Like I was like when I was actually doing a lot of single families, I was trying for different markets, different places where I can find some cheap, something to start with, and then do some burst strategy to do it. And then I bumped into Jacksonville, Florida for a single family stuff. Then I was talking to a property manager saying that, now I'm not interested in single families anymore. Like, I want to do multifamily. So like, yeah, we manage small multifamilies as well. The max we manage is a 40 unit. If you're getting a small multifamily, we'll help you manage it for you. Then we started looking to properties in Jacksonville, and we bid this property, this 20 unit property called Kingsbury Apartments. It is on market with the broker, and we offered like there are multiple offers we offered on it, and then it is actually a bad shape. Like the roofs are leaking, like 4 units are down to studs. It, but it's for us like somebody coming from Bay Area thought like, okay, this is more like a townhome flip. Like we got it for like the amount of money for our investors that we got. Like man, like this is like a flip in a townhome. We're doing it for a 20 unit apartment. Let's just do it.
So, is that one? Are you actively repositioning? Are you going
Yeah.
to turn that? Are you looking to
uh,
retain?
Multiple options, as you know, right? Situation right now
Right.
we have a bridge loan. It's 70% occupied when we bought it. Lot of rehab. It's just we replace the roofs. We have 4 units down to studs. We are actually rehabbing those units. um, we will see, like based on situation, either we will apply for a Freddie Mac small balance loan based on how much it is priced for, or we sell it and we exchange it with a bigger property. But it is actually really good experience. I that's my first property, and now I got to know about a lot like demographics, what is median income, how to turn properties, rehab budget, like how conservative you have to estimate the rehab. So these are like, even though you learn a lot from so much of these boot camps, Darren, right? Until you do this practically,
Oh yeah,
right?
yeah, yeah.
Right?
Tell
The
you, tell
issue,
you, you're taking the calls and live bullets. I get it. It's
yeah,
yeah, I'm with you there. So
that's a good learning. So for me, I could then the later we bought a 12 unit. It's still a C property, but in a 59K median income. So when I was like seeing these median incomes, I was not getting it. Like until you buy these things and you operate, then you know how the collections are, how the turns are going, how many bad apples we need to remove. So I can actually clearly see that. Uh,
wait. So you said there was something. Was it 59K?
the median income for the 20
Oh,
unit is
median. Oh, gotcha.
median
Median
income
income.
is 32K for the median income here, and here it is 59K.
Oh,
So I
okay,
could
gotcha.
actually see the tenant quality, the collections we get for a monthly rentals, right? So I see a huge difference. Like then a lot of people are saying like take care about the demographic, the median income, the all the other factors. Like I didn't get it until I bought these things and operate, right?
Right. No, and I hear you because that's something, I think, and I can speak from my own personal experiences, paying no attention to the market and, being focused on the property only until, you start realizing the problems you're having and realize that not everybody has those problems if you identify a market properly and
Right.
understand the fundamentals of the marketplace.
Yes.
You can drastically improve. So, all right. So the 20 units a major rehab. The 12 units, are the 12 units
Uh,
operational, or is that a
So
reposition?
two units are down. So we actually like the 10 units are up and running. We can actually cover our debt service. Everything is good. We get a little bit cash flow. We're rehabbing the 2 units right now. That is also, a rehab project. So with
Major rehab, or you said there two are empty. Are they major
yes,
rehab or just minor?
those two are actually major.
Okay,
Other than that, the other, so it is actually, kind of a sixplex, a fourplex, and a duplex kind of thing. It's like not a kind of an apartment style. They're not running as that, but it's a 12 unit. Uh,
gotcha,
yeah.
gotcha.
So they're all in one parcel.
Okay, and then the 30 unit, was that the third
Yes.
acquisition?
Yes.
All right, tell us a little bit about that.
That's a scary part. It's a D property, but it's a completely renovated one. We kind of lowballed and got it at a very good price. We That's a really good experience for me. We kind of turned almost like 65% of the tenants.
Wow.
It's a lot of learning. So then I kind of, after these three, Darren, I wanted to like say I want only stabilized properties. I don't want to go into this project. Like I don't want to have these many projects going on. So
Right.
the Casa Grande, the Elm Tree that we're closing, these are like 98% occupied, stable, Freddie Mac loan, 10, 20 years. So I want to like shift my gears to that. So that's the reason I was like,
Right. Well, you've done a lot in this last year. You've learned a lot.
I learned a lot. It's just,
Right.
I kind of reading through so many webinars, podcasts, like boot camps. You don't get it until you do these things, right?
Right.
So
No, eventually you've got to just put down the book, take off the headphones, quit going to the
exactly,
meetings and actually just go and do it. And
exactly. But
yeah.
for me, I would rather do these mistakes in a 20 or a 30 unit than a 200 or a 300 unit. So
Oh no, totally agree. I was actually just having coffee this morning with a couple of real estate investors, and we were basically, agreeing with what you said. There is, learning your lessons on a smaller property on what to look for and what works and what doesn't work is much easier to translate or to weather on a smaller property than it is
right.
on a larger property that could just sink you, kind of thing. So,
Right. But at the same time, you can partner with someone who did a 200 unit complex, and then you can learn from that as well. It's not that, I wouldn't advise like everybody do the same thing, but it's still okay to do that. But at the same time, if somebody's already did it, you can partner with them, even though you get a little bit less, GP share cut, but you can still learn a lot from that aspect as well.
got it. So when did you close on the 30 unit?
The 30 unit, it's around July.
Okay. All right. So from January through July,
Yep.
my count is you acquired 62 units
Yes.
at varying conditions or class of properties, from a D to, what do you think is the highest,
Yeah,
like
I
B
think,
minus, C
yeah,
plus?
it's a B minus, B minus, a C minus, and a D.
Okay. And the lesson that I'm hearing that you learned in that was the marketplace, understanding the median income,
Yes,
probably one of the primary lessons, and then also what level of value add you're wanting
exactly.
to do.
Right. For example, Kingsbury, we estimated around 75 to 90K our rehab budget. We're all in at right 150K right now. So in the sense, like, you have to conservative in estimation, get a really good, like we got good inspection report, but still the
Yeah.
moment you open up the roof, right, how it is.
Yeah. No,
Yeah.
if those walls could just talk before you opened them up, you'd know better, right?
Yeah.
So, all right, well, let's talk about,
Yeah.
okay, you acquired these three properties.
Right.
The projects are gone, but you're not done. So you go and were you on the hunt? Were you talking to investors? How did you make the decision
Right.
to
So Darren, so these three are more like a partnership LLCs, like operating
okay,
agreements. We have like some, like one has two, one has three, one has four. So we kind of partnered together and took down these deals. But then I said, like, no, when I was getting these properties, talking to brokers and investors, they're interested to invest with me. Then I said, okay, let me syndicate this thing, and then I decided to have stabilized properties, good value add, and then I want to get long-term debt. I don't want to get so many bridge loans right now because these are projects like 70% occupied right now. What I'm having, I want to get value add, but at the same time not external value add. I want to go inside the units and do typical syndicatable value add play, right? So
let's qualify the difference in the value add, because I would
right,
say that by what you've described so far, the ones that you purchased up to this point were more of a heavy lifting. You had vacant
right.
units down to the studs. I mean, you're essentially in a remodel renovation period there. How would you characterize the former versus the latter?
So see, so if, anywhere you have to find value add deals. Do not speculate on market rent growth or any other appreciation that you assume stuff, right? So if you find value add, then you have to see how much you can take. Do you want heavy lifting, big value adds? Do you want to just a light value add? Because the time takes, right? Because for the Kingsbury, we're still spending 6 months, 7 months, 8 months. So to get this thing up and running, to have occupancy at least, right? Now for Casa Grande, it's already 98% occupied, no different maintenance at all. Just go in and then do interiors. The moment there's a turn, rehab $3,000 to $5,000 based on the demographics and market. Put a light rehab or a major rehab and raise the rents to the market. So I would say if you're syndicating a deal, better find a value add properties where if you want to just to have not a heavy lifting, just do only interior rehab. But make sure that your current rents in the property and the market rents have a significant, not very significant, at least some room for you to grow, right? Like $75, $100, $150, whatever it is, have some room to grow, and then go in. If you're starting, do not go with heavy lifting, which I
Gotcha.
did, but I did for smaller property, but if you take the chance, you can still do that.
Gotcha. Let me ask you, when you look at a $3,000 to $5,000 value add, light value add, is there a rent target that you would expect that when you're modeling your pro
Right.
forma?
Right. So see, I have in the Casa Grande, we have around $75. The average rents are difference between market to current. That's just huge. If you just do 75 into 59 units and you calculate at least 7 cap or 7.5 cap, that's a huge bump. That's exactly what we're looking for. So we get cash flow the next 5 years. So when I analyze the property, any syndicator says want to double their money in 5 years, right? Just a typical one. So when you do this double 80%, 90%, 100% returns in 5 years, whatever it is, when I say I'm getting 100% returns, I would want 50% returns from cash flow and 50% returns from the exit price. If you speculate, I'm getting only 30% from cash flow and 70% from exit, you're kind of speculating a lot, right? So I would, have this in 50-50. So when I did this thing, I could definitely raise the rents for $75 in this 5-year hold, and then I can increase my net operating income and get 50% from exit and 50% from based on the cash flow. We got a 10-year Freddie Mac loan. We have a constant the expenses from a debt service there.
Right. And what was the term on your loan?
It's a 10-year.
A 10-year fixed for
10-year fixed.
Oh, that's great. That's
Yeah.
great. Okay, let's talk a little bit about the path as far as okay, you had the investors that you'd been talking with, and
Right.
they wanted to participate. You made the decision. Okay, the next one I'm going to to syndicate.
Right.
Well, how many deals did you have to look at between July and you closed on this last one in November, correct?
Yes.
Okay.
In end of November. Yeah.
Okay. How many deals did you look
Uh,
at?
so many, it's just hundreds, I think, right? And on all other markets as well. I'm looking really into Raleigh and Atlanta. So my markets are South Atlantic, North Carolina, Atlanta, Georgia, and Florida, right? So these markets I was looking a lot and was offering so many properties. But Jacksonville, what I got, Darren, is like I'm getting this kind of a domino ripple effect. Like, when I'm closing these deals, other brokers like, hey, like, Rama, we have other stuff. When I'm showing them I'm closing this deal or when they're under contract, they're giving me more deals. It's just the domino effect I'm getting there. So
Right.
I was like thinking like, then, okay, if I have to have same system in Atlanta or Raleigh, it'll take another 3-4 months for me, right? In sense, like brokers are texting me, calling me, like, I'm just emailing them, and like, having this good relationship with them, which I want to replicate in other market, it takes time, like 3 to 6 months, right?
Right.
Why they will believe you, in a sense, you'd never close a deal here. It's just the chicken and egg problem I need to solve in every market.
Right. Right. So how long have you been on the ground in Jacksonville? Is it that first deal, the first 20 units? Did you?
Yes, that's the first time I went visit Jacksonville, and after that I visited 5 times. So kind of once in a month I go, or twice a month, and I also ask my partners to visit, my investors to visit, like especially like I'm kind of delegating some to my partner. Okay, like we got this deal. Okay, now your turn to go and see how the rehab is going on, right? In a sense,
Right.
so I'm kind of leveraging other people in my team as well.
Got it. So you said you analyzed hundreds of units or properties.
Yep.
How many letter of intents do you think you submitted?
A lot, like more than 20.
All right.
Yeah.
And was this the only one that you got under contract, or?
Uh, we have other contract, like in the sense LOI accepted, but didn't went under contract because of several. The moment we get into PSA, there's some back and forth. We didn't agree. We had to like kind of back out. Like see, a lot of these things, right? The game. Like you might get under, like back out on several things. Like you go under contract. We even Casa Grande, we retraded this deal. Like when we got information, it was different. When we went inside, we did very good inspection, and we got a lot of different maintenance and building code violations. And then we discussed about this. You remember this slip and fall, like the large claims, loss runs. So then we retraded this thing. Hey, like this is what it is. Like then
Right.
yeah.
And when you say retraded, though, but you had information that was different than what you had, when you were originally made your offer.
Yes.
At what point did you communicate that to the seller or the seller's broker that hey,
Yeah.
we've got some issues? Did you do that along the way, or was that
Right.
like a?
So after we finished our due diligence, we got an inspection done. Like every unit, we walked every unit, roof. We had the drones, sewer lines, everything, and we compiled all the issues. So I usually don't go in a thought process that I would retrade, like unless if there is some deferred maintenance on it, right? That we don't know externally. Like when you go to the initial tour, everything looks good, right? We didn't went inside at all. So and then we had some building code violations, like slip and falls. The railings were really like maybe an adult can go inside and then fall from the railings, right? So we had all these building code violations, every issue that we could able to do. And Freddie Mac had the inspection done. We got the report, a huge report from them. We took all this information and went to the broker saying that hey, this is what it is, and we want to retrade this deal.
Was there resistance? Was there acknowledgement? How'd that go?
There was a lot of resistance, and we said like this is as is kind of thing. The selling broker. So we kind of had a meet in the middle. We kind of had around $180,000 of deferred maintenance we showed because everything's, and we retraded with the 50%. Like they came in at 90K. We guess like no, we can do 90K out of the overall. Then we budgeted remaining from ourselves.
Gotcha. You shared with me, and I don't know if you care to talk about it, but I think as an insurance agent, it was interesting for me,
Yeah.
and I'm sure that any of the listeners could, appreciate it.
Right.
A lot of times, insurance is kind of it's not a want, it's a need, and it's something that people will either use the seller's numbers or,
Right.
have a
Rule of
guess.
thumb.
Yeah, rule of thumb there. Can you tell a little bit about what you came across and how it presented itself and what
Right.
what the outcome was?
Definitely. So on this deal, the broker on the OM gave like $12,000 as a pro forma insurance, right?
Right.
Then I underwrote it with $18,000. So when we got the quote, it was $29,000. Wow, like it was like crazy. Um, then we got in then we found a very good provider where they suggested us to have a master insurance policy where you can put other properties, and then he kind of shopped around with a bunch of providers, and we kind of laid our story. So this is what it is, and we have some loss runs. Like we didn't know, you need to analyze this. When we talk to this, like that's a huge loss run. We don't know what the provider sees. And initially, when I thought, I'd want to step back here. When I wanted to do insurance, I thought like more like Geico, right? Like 15 minutes or something. You can get a
Right. Right. You'll
quote.
save 15% if you just make a couple more
Yeah,
calls.
like no, this is not. It's a commercial. It takes 7 to 10 days, man. Like whenever I'm getting a thing, it takes 10 days to get me a quote back. Then I kind of we waited. We got a really huge bill, like 29,000 quote from the provider. Then we went to the master insurance policy. Very good provider, really good provider. I recommend Franklin Street Insurance. So he gave us a very good master policy by discussing the story to the provider, saying, hey, these guys are buying in, they're doing value adds, they're going to fix the railings, they're going to fix all the slip and falls, they're going to make sure the property is value added. So the story is heard for a couple of providers. We got a very good quote, close to $19,000, which is real close to my pro forma. I was really happy. But
Right.
but I would suggest to anyone to get the loss runs, conservatively estimate, like say at least $300 to $350 per door, and then get a soft term sheet, at least some soft term sheet from an insurance provider, based on, and then verify and go to FEMA website. It's just free. It takes,
Right.
3 minutes.
Not in a flood
Go,
zone there.
go to FEMA and verify if it's a flood zone or not. So, and then verify if there are any fires before anything else, just get the loss runs, make sure it's impacting your insurance. It's a make or break for your deal, right?
Yeah, no, you're speaking the truth, and it was refreshing to I don't want to say refreshing. It was interesting to hear from a buyer's standpoint. Kind of the assumption made going in, and then the information that you were having to interpret, and how it was affecting your numbers, the cost, and what was was there a solution kind of thing. And I think that, just to reiterate that, is I think that any of the listeners, if you're looking to buy a property, that one of the documents you need to lay your hands on is the loss history for the seller's insurance. And because going forward, in order to get your best rates, you're going to have to be able to provide that to an insurance broker.
Right.
And if there's anything that's any numbers or any claims or whatever, you're going to have to be able to explain to the new insurance company why that's not potential for future claims, because that's
Right.
basically, insurance looks at the past as the best predictor of the future.
Yep.
So that's great. So this property is stabilized, correct?
Yeah, it is 98% occupied. We just closed it 2 weeks back. We had a you know welcome party to all the tenants. Like we had some raffles. It was all good, really good, went well. They're like long-term tenants, 5-year, 10-year tenants. So we kind of did some appreciation event for them. So our idea is to just go slow. This is a good occupied property. We don't want to do any drastic changes. We're adding a lot of amenities here, Darren, like replacing the leasing office and putting into gym. We're adding dog park. We're adding self-storage units, covered parking, reserve parking. We're adding a lot of these amenities here to the tenants. We had a very good swimming pool there. They put in very good condition. They put a lot of money, the previous sellers. We want to just keep the property there, and then whenever there's a turn, we want to renovate it to like put up $3,000 to $5,000, but as I said, and then increase the rents to the market.
Gotcha. What is your value add? I mean, you've mentioned a lot of the physical things you're doing. Is there a rent increase, room for a rent increase, or?
Right. As I said, the average is around $75,000 difference, but we need to renovate the units to bring it to the market. That's our play. We will renovate the units whenever there is a turn, and then increase the rents to the market rent.
Gotcha.
Yeah.
And did I hear you say that you've got another one under contract, right?
Yes.
That you mentioned that it was under contract, but you backed away, or is it
No,
still?
this is under contract.
Okay.
We're closing it on next week. It is actually half a mile from Casa Grande. Like, interestingly, it's a different broker. It's a really good broker again. These are all relations. Like, these are all off market. Except the first one, Darren, the Kingsbury Apartments. Everything else is off market from brokers. Like, good relationships with them. This one is really good deal. It has some issues. We kind of resolved it. Like, it has the issue of a lifting station. It has a lift station. I know
I'm sorry, say it again. Has a what?
a lift station.
Oh, lift station. Oh, for
Yeah,
like the waste
but for the sewer
sewer.
lines.
Gotcha.
Yes.
Gotcha.
So there were some, like, the previous seller replaced everything, but it's waiting for approval from City of Jacksonville. We kind of waited with the seller. We worked with him to actually get this thing resolved, and then it's a really really good deal.
And how many units is that?
The 32 unit. It's again 98% occupied. We're getting a Freddie Mac loan. Hopefully, we'll hear something on Monday or Tuesday with Freddie Mac. We got a very good leverage there, and it's a 20-year loan, 10-year fixed, 10-year floating. We got close to 82% leverage on that. Really good buy, and then the appraisal came in really high than what we got under contract. That's a really good home run deal if you close.
Well, that's a quite a story in a year's time. How you've gone from saying enough on the single family, let's go multifamily, and I like the domino analogy. I mean, what you said is that once you recognize in the marketplace, all of a sudden your phone's ringing and
Right.
you're being presented opportunities, because I think that it's so easy, especially in this age, to look on LoopNet or whatever, even if you go CoStar or whatever and find all the properties. But
Yes.
at the end of the day, this is a who market and knowing people.
Right.
And you've certainly proven that.
Yeah, definitely. Like, I see that, because now I was telling them, like, these brokers are giving me more deals. I said, like, hey, we already have 2 loans going on. I said, like, I would like rather wait to get this thing closed. They totally understand as well. Like, I know you too many things going on for you, and then they totally get it. Like, when I was talking to them right now, I'm telling them I want like a little bit higher units right now, since I had closed a lot of small deals, like 100 plus units. They understand totally. They work with me and then see, okay, if there's anything coming before market, you want to take a look. So those are the good relationships I wanted to continue having it. And if I'm not actually, not able to close it or something, I wouldn't go inside. I toured the properties, some of them have. I said, like, I don't want to even offer because there's too many things going on for me.
Well, it's and they understand, and clearly you've got your hands are a little bit full right now. Just want to make sure you get everything done. I would guess you want to get these closed and before you move on there. What about management? Are you doing everything third party, or are you guys looking at possibly creating your own?
No, nothing yet. It's just primarily as like, I'm kind of acquiring more, and then I don't want to especially these are like coast to coast. I live in San Francisco. This is Jacksonville, Atlanta. I don't want to like do anything on my own. But I got a very good property management, St. John Properties. The advantage for me at this point is all these 5 properties are in, like, it's a 10-mile radius and in one market. I can have a weekly call with them and a monthly, one statement call or visit there. I can just do everything at one shot and do it. Like, say if these 5 properties are in 5 markets, I will be like, man, it's crazy, right? Just
Right.
it will be difficult money for me to have this scale.
No, I hear you. Definitely nicer to have one call and one point of contact as opposed to have to do multiples. Or that's great.
Right.
So what do you see for 19? Do you mentioned you're looking for 100 and up? Do you when I ask this question, I guess there's a couple of parts that I'm thinking.
Yeah.
One is, what you see, but do you have any sense of change in the market? Anything changing in your underwriting?
Yeah.
Um,
So that's another, like I'm still looking into some deeper value adds as well. Um, just because, see, like, and also from a number perspective, the unit number perspective, Darren, I would rather get a good deal, which is a 50, 60 unit, than getting a bad deal on 200. Just like, I don't want to have like ego or something. But the only reason I'm going 100 plus is it's the same amount of work for 50 unit or a 150 unit, right? So I
right.
would rather like have a scale there, because like even if it's a 30 unit property, 50 unit property, I need to have the same call, same conversation, same business plan, everything exactly same, except like you need to raise more capital, right? That if I can scale that aspect of it, or if I can find partners who can actually like raise some more money, because you know for these 5 properties I did end to end complete, like LOI, finding relationship with the brokers, lending, insurance codes, 506B, raising money, you know closing. It's just like a post business plan. I just did everything end to end. I just kind of burnt out, you know but the thing is that the reason I did it is to just to learn every piece of the puzzle, right?
Right.
So when you partner with 3 other people, you're kind of shielded with so many things, and then like you don't know those that piece well, right? Now, since I did few transactions, I know I kind of shared this into some webinars already. I'm going to share it with the larger audience. Just want to share what I kind of experienced so that the other people don't do these mistakes, right? I'm kind of sharing this presentation I did with several groups, you know, end-to-end process of like, this is not a textbook thing. This is like real practical stuff, right?
Right.
What happens in every phase and what the gotchas, like I kind of experienced. But the problem is, like, even if I tell these things, 95% of people don't get it until they do these things, right? They are in the sense.
Well, I think there's just certain things you can't transfer the knowledge without the actual the experience. You can, read the story, but until you've lived it,
Yeah,
it doesn't seem real, or it's theory.
right.
Once you actually are put to the test, and you see what a down unit is, or what the marketplace, why it's harder to collect rent in this marketplace as opposed to
Yeah,
another marketplace,
yeah,
or the value of a higher class property with little or no uh, heavy lifting, but more
right.
of just a rent reposition. um, Makes a lot of sense if you only have to do a little bit to get $75 more per month, whereas
Yeah.
in these other ones, how much do you think you're getting in these other ones, that you're the smaller units? You mentioned in your 2012 or your 30, how big of a rent bump do you think you can get in those based on your reposition?
Those are more like a flip kind of stuff, right? Those are like,
Right.
this is like we got it for cheap, much way less than the price per door that's going on the market, right? These are like, heavy stuff. So that is just like, flip based and get to the market average price per door. That's just you have a very good spread there for you, right? So that is just to, if you make it 100% occupied, fix all the different maintenance, you win the deal, right? That's it.
So
So
that one's not necessarily the heavy lifting. There is basically get it so it's all occupied and you can move on.
right. So
Gotcha.
for those 2 or 3 properties, I can actually stabilize this thing, get a Freddie Mac, and cash out my money. Right.
Right.
That play, or sell it in exchange with a bigger property. That is the play there. This is more like a yield play, 10-year, 20-year loans, and then I want to like typical kind of a long-term strategy. Like that is what I like. As you said, 2019. I want to you know right now what I'm doing, I'm a sabbatical right now. I want to step back, build a system to scale. My goal is to reach 1,000 units in next 5 years, of course with partners, not burning out myself. Uh, and then the way I going to do it is building the system, and also make sure get when you see this deal, I know with the experience what I did this year, and make sure what it is. Like you're okay to do C minus, but you need to know what you're doing. Like underwrite it properly. It's
Right.
not I'm not saying like some people are not interested in doing an EC. Like some people are interested in doing B only, right? B and A. So I'm okay to do C. I'm fine. I understand. Like our motto is to give, our mission from Zovest is to give passive income to our investors, and at the same time give safe, affordable, and clean properties to our tenants, right? In a sense, like we have all demographics in this country, right? You need to serve everybody. So I don't want to discriminate anything like that. So, but the thing is, but when you know what you're doing, that's exactly like, no, it is 25K median income, and underwrite it properly like that. Talk to PMs, see if it's a war zone or not. You can do it in war zone, but you should know if it's war zone. What kind of measures are you taking if it's a war zone, right? But don't underwrite a B property style into a war zone and assume the returns, right? When on paper, when I'm getting these deals, like, oh, my 70% cash on cash, you're not going to get this thing.
Right.
You're not going to get even 7% cash on cash just because you have underwritten wrong, like the turnover cost, right? You'll have 30% turnover, 40% turnover. You don't know, how much rehab it is you have underestimated. So everything. You can go to a D, but you need to underwrite it effectively, and then you can do it. That's the thing.
I gotcha. So I got to ask you a question. You started this by saying that your dad said, whatever you do, don't buy real estate.
Yeah.
Now that you've got over 100, you're closing in 150 units. What's your dad say now?
Unfortunately, he passed away 5 years back. But yeah. But yeah, it's just like, it just, I don't know, somehow that's what it thinks, right? Like, so they have some more misconceptions when they're born and then raised, right? Like, he's not against that, but he said, like, do it, like, when you settle down, wherever you are, buy your primary home, do not buy anything else, like, any not even close to renting something else, right? Just eventually you retire and you buy something, like, back in India, right? Everybody buys a home previously. Once they retire, they build their home and they retire in their home, right? So it's just, it's just completely different. It's just different.
Yeah. Well, I'm sorry to hear about your father's not able to see this, but I'm sure he'd be proud. So, Rama, if there's one thing that you'd like the listeners to walk away from this, what would that be?
Yeah, so definitely, this is so much of up and downs. Be passionate about what you're doing. It's not, it's not a get rich quick scheme. It's a get rich slow scheme. It's like, you're going to be slowly going rich, right? It's like an entrepreneur, right? You have a lot of up and downs. Like, you underwrite 100 properties and like submit LOIs for 10. Like, I haven't got anything yet. That's fine. Like, you need to keep doing it again. It'll be like a lot of up and downs, right? You might go under contract and back out. You might lose some money on due diligence. Like, there will be a lot of up and downs. You just have to stay passionate about this business and, keep yourself motivated. Like, I get like a lot of things, like, like when I was traveling, like, with the kids, my wife is kind of struggling, right? In a sense, it is difficult. Like, I have 2 small kids. When I'm traveling, and then it's difficult for her to take all these things. A lot of up and downs, but just be passionate about it. Like, whenever I'm down, I listen to a few podcasts and then read some books, or like, read some blogs, go to Facebook and see motivation. And like, it's just, you need to keep bringing back yourself and then start again.
That's great. Rama, where can the listeners go if they'd like to learn more or connect with you?
Yeah, I can go to my website, Zovest, 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 or they can email me at Rama, RAMA, Zovest.com, or they can even call me at 408-904-9990. Yeah, so any methods, they can reach me out.
Great. Well, I'll be sure to list all that in the show notes. And Rama, I wanted to say thanks so much. I've enjoyed it and I've learned a lot, and I hope we can do it again soon.
Yeah, thank you very much, Danny. It's a privilege for me to be on your show. We'll talk again.
We will. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.